Hi, my name is the Grand Accountant, and today's lesson is about the matching principle and how we're going to be applying it for deferred expenses and accrued expenses. So let's begin.
So what is the matching principle? By definition, it is where expenses must be recorded in the same time period they are incurred. So why is it so important? Because of the accrual accounting method, of course. Here's a more visual explanation.
The accrual accounting method is one method accepted by the generally accepted accounting principles. It has two halves. You have revenue and expenses. Revenue is governed by the revenue recognition principle, which is not what we're covering today. But we are covering the matching principle, which governs expenses.
I know what you're thinking. Where is it used? The matching principle can be used when we record deferred expenses.
Deferred expenses are transactions where cash is paid before the expense is incurred. For example, if I bought $5,000 worth of prepaid insurance for 12 months, I will record this original transaction in the current period by debiting prepaid insurance by $5,000 and crediting cash by the same amount. This reflects the flow of value from one asset to another. The next period, if 6 months were to pass, I would require an adjusting entry. In this case, there's only 6 months worth of insurance left. Thus, we have to reflect this by opening an expense account. This expense account would be debited by $2,500 and prepaid insurance would be credited by $2,500 to reflect its loss of worth. Hence, the matching principle is reflected using deferred expenses.
It can also be used when you're recording accrued expenses.
Accrued expenses are transactions where cash is paid after the expense is incurred. In this example, I borrowed $10,000 as a promissory note that has 5% interest for 12 months. 6 months has now passed, and the interest expense must be recorded in accordance to the matching principle. Therefore, we require an adjusting entry, where I would debit the interest expense account to show that we have incurred this expense, and the interest payable account is credited since we still do owe our payee this amount. Now, in the next period, once our note is due, I would have to debit interest payable to reflect that we are now paying for the note as well as its interest, and cash is credited to reflect this reduction in an asset in order to pay for a liability. Hence, through accrued expenses, we use the matching principle.
So, to recap, it is one of the generally accepted accounting principles. It also serves as the second half of the accrual accounting method, and its definition is expenses are recorded in the same time period they are incurred. And the matching principle is also demonstrated using deferred expenses and accrued expenses. Farewell, and I hope that you learned something new today.